Most people won't watch this entire Federal Reserve press conference, but they should, because buried inside is a quiet warning about job growth possibly turning negative, inflation that isn't really gone, and a Federal Reserve that admits there's no risk-free path going forward. Today, I'm going to show you direct clips from the Fed, then break down what they actually mean for you, your job, housing, savings, and where rates go next. Welcome back to the channel. If you're new here, I break down what's really going on in the economy so you can make better financial decisions. If you find value in this video, please like, comment, subscribe, and share this with a friend. That really helps the channel grow. All right, let's get into the Fed's own words. Taking a look at our first clip, the Fed is addressing that the labor market looks a lot weaker than it looks. They're talking about unemployment and a hiring slowdown.
Job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year.
The Fed is telling us that the labor market is cooling a lot faster than headlines suggest. Unemployment is up 4.4% and hiring is slowing down. Not collapsing, but weakening. This matters because the Fed only cuts rates when they believe job risk is rising. In this next clip, the Fed is addressing that job growth may be overstated.
Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month.
This is one of the most important moments of the entire Fed press conference. The Fed is saying official data shows plus 40,000 new jobs. The reality might be negative job growth. That completely changes how we interpret the economy. This is why they're cutting rates before layoffs show up everywhere. Let's take a look at this next clip. It covers why the Fed cut rates again.
At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals.
That line, no risk-free path, is key. The Fed is openly saying inflation is still too high, jobs are weakening, and any decision carries risk. So they chose a balanced approach instead of waiting too long and breaking the job market. This next clip is covering what is really causing inflation.
You know, in terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods. And that goods inflation is entirely in sectors where there are tariffs.
This is crucial. The Fed is telling us inflation isn't being driven by wages. It's not demand overheating. It's mostly tariffs raising the prices of goods. That's why they believe inflation could be temporary, not structural, if it doesn't spread. In this next clip, the Fed is going to address if more rate cuts are coming.
And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
In translation to that video, the Fed is saying rate hikes are off the table, cuts are still possible, but nothing is guaranteed. From here, the Fed is data dependent, especially on jobs. In this next clip, the Fed is addressing AI productivity with jobs.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time, so it's basically a good thing, but that's certainly the implication.
This is subtle but important. The Fed is seeing higher productivity, economic growth without hiring more workers. That's great for GDP, but it raises long-term questions about employment stability. In this next clip, the Fed is answering a question directly about housing affordability.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Affordability won't magically improve. If you're waiting for cheaper homes because of rate cuts, don't hold your breath.
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both.
This sums it all up. The Fed is trying to control inflation, protect jobs, and avoid a recession. And they're doing it in one of the hardest economic environments in decades. If you want to stay ahead of shifts like this, subscribe to the channel, hit the like button, and share this with a friend who keeps asking what's going on in the economy. I'll see you in the next one.